Welcome back to chapter 11. Today we're going to be looking at depreciation and under depreciation, there are three methods that we're going to be teaching you today. All right, this is the first one. It's called units of production. But let's dive into what depreciation is first, and then we'll go ahead and see what the methods are. Depreciation. What is depreciation? Depreciation is a method that allows fixed assets to, in other words, hold some kind of value. Okay, especially when we buy our fixed assets, right? It 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 holds a value because we paid for it. Whatever price that it's worth is what it costs, right? However, due to the historical cost um, principle, we understand that as we have this asset on our books, it doesn't change in value over time. And realistically, that is not true because, especially when we wear and tear our fixed assets, right? Eventually, it doesn't hold its value any longer because you use the products. Okay? Sometimes even fixed assets become obsolete. It's no longer in service anymore, or they no longer have the parts to be able to keep maintaining it. So what is depreciation? Depreciation is a way to represent the usage of a fixed asset, the wear and tear. Okay, it's our way to measure how much we used a fixed asset. So then, if and when we do plan to get rid of the asset, right, we know that it shouldn't be worth what it is when you originally bought it, right? Um, you have to adjust the value of it because, of course, when you open up anything, right, that already takes value off of an electronic, okay, especially if you have things that are open box, those things are like marked down by like 20% just because you open the box. Okay, so at the end of the day, a lot of these fixed assets, right, as we purchase them and we start to use them, they depreciate and lose value over time. All right, so depreciation. All right, so this is for any tangible asset, okay? So anything that you can touch. So tangible assets, also known as fixed assets, okay? Because so anything that's a property, plant, or equipment, right? It's tangible. It has a physical touch that you can deal with, right? And um, we're going to depreciate it over a span of a period of time. Okay, because depreciation doesn't happen by day, it happens over a span of specific times. Okay, an example would be a computer, right? You bought a computer, what, I don't know, 2018, and the more that you use it, right, things wear and tear, right? The battery doesn't work anymore. The CD drives doesn't work anymore. Every time you turn it on, it gets slower, right? The operating system's just slow. Things like that. Okay, computers have life. Okay, they have a span of how long you can use it. All right, so other examples are computers, furniture, okay, trucks, buildings, and land. Land will be the only exception to this rule since it is part of property, plant, and equipment, right? It's part of property. Land actually does not ever get depreciated. There's actually another word for it. But as far as the advanced level of accounting, you won't actually know how to deal with how to depreciate land until intermediate and more advanced levels of accounting. Because land can also hold value, right? Especially if it has natural resources such as diamonds, oil, petroleum, and all that stuff, right? So land is actually valuable, but the more you keep extracting all of those natural resources, right, the land becomes depleted, okay? So once again, land doesn't depreciate, it depletes. It's just another terminology, but essentially it does the same thing. It just, loses value over time, okay? But in this case, it loses value because you're taking resources out. But land can never be depreciated, okay? That's one of the concepts that you need to learn as a beginner in accounting, that it can never be depreciated, right? There's another terminology for it. Okay? So then let's go ahead and take a look at these rules here, right? I've mentioned this earlier, right? This is governed by the historical cost principle, right? Where when we acquire our assets, we must record them at the value that we purchased it or acquired it, right? We call it either face value, fair market value. The day that we purchase it is going to be the amount that you're going to record in your books. Okay? Now, there are some rules to the historical cost, right? Yes, you can revalue it and it to extend its life, but again, it's not as easy, it's not as difficult, but yes, you can change the value of it by adding fixtures. So again, think of that you buy an old car, right, and you add a paint job on it, then you change the transmission, you upgrade the seats to automatic, right? You're adding value to the car now. Yes, you can, and that will be the only exception to the historical cost because you are adding value to a fixed asset. Okay? And yes, that will also extend the life of the fixed asset as well. So that's the only rule that you can use for this, but you cannot deliberately mark and take value directly off of the asset itself. So when you depreciate, you're going to have a contra account called the accumulated depreciation, where it just basically it calculates how much you used the asset, and when you sell it, which we'll talk about in chapter 11.5, and you get rid of your asset, is when you actually determine what the true value of the fixed asset is, right? But right now, your rule here is you need to record it for whatever value it is at time that you purchased it. And the second one is going to be matching principle, because for every dollar that you purchase the fixed asset, right, you have to have the equal amount of depreciation. So you're matching the depreciation, which is an expense, to the fixed asset itself. Okay? All right, so let's talk about the components of depreciation. There are 5 key components that you must be aware of, okay, in order for you to be able to calculate and do depreciation, okay? Number 1 is you need to determine the cost of the asset. Number 2, you need to determine the estimated useful life or the expected use for production. Okay, we'll talk about what that is. 3, you need to determine a salvage value or a residual value. 4, you need to determine the date that you place the assets into service. Okay? And last but not least, you need to determine the depreciation method. Okay? So these 5 components is how you're going to get started with your depreciation. Okay? So number 1, let's talk about the cost of the assets. Okay, now the cost of the assets, pretty straightforward. It's going to be all the costs it takes to get not only the asset to the store, but to get it ready for service. Okay, so anything that's included, such as obviously selling price, right? When you buy your fixed asset, that's going to be part of the cost, right? Shipping, okay, especially sales tax, okay, because we're buying fixed assets. You're going to be charged sales tax no matter what, okay? Any product fee. So let's say you buy a computer, maybe you need to buy Windows operating system because it doesn't come with it, then that's going to be included as part of the asset because it's part of it's how you're able to run your computer by having the operating system. Okay, those are extra things for you to get it ready for service. Shipping and handling, once again, getting it to your store. If it requires training, so if you have a machine and you need a professional to show you how to use the machine, that's going to be considered part of the cost to get it ready for service, as well as installation fees as well. So if you need to hire somebody to install your fixed asset, that's going to be included as part of the cost of the fixed asset. So in this case, it's the same thing as inventory, but the only difference is it doesn't mean you get it to the store. You need to get it ready for service. Okay? So those are all the costs it takes to get the asset ready for service. Is going to be all of these costs to include as part of the fixed asset. Okay? Number 2, the estimated useful life and salvage value. So this is part 2 and part 3 in together in one. Now, the reason why it's together because there are rules and regulations, especially when we are determining who and what and when your fixed asset, like for example, estimated useful life, right? Under the rules of Acct and IRS, if you are a corporation, you must follow these rules. Okay? So in this case, they have similar to a Blue Kelly book, right? For Blue Kelly book is for cars. They have a similar to a Blue Kelly book for all fixed assets. Okay? All right. This book determines how much time or how long a fixed asset should last you. Okay, so the typical ones that you'll see are usually 5, 7, 9, or 11 rule. I didn't mention the 9 or 11 rule because we wouldn't see any fixed assets that are could be potentially 9 or 11. So for example, 5 years would typically be any computer, any phones, printers, registers, okay? Where 7 years is usually any type of machinery or furniture, okay? So they already mapped out how long a fixed asset's going to last you. It's already predetermined in this typical Blue Kelly book for fixed assets. Okay, so again, 9 and 11 is usually for buildings. Okay, but in this case, we're not going to ever own a building. So, but in this case, right, it can be also predetermined by looking up how each fixed asset works. Okay, so again, usually typically it's 5, 7, 9, or 11 years. Okay. But also under this, right, since corporations have to follow these guidelines here, right, they also have to follow the guideline that for salvage value, that all fixed assets are not going to have a salvage value. What does salvage value even mean? Well, salvage value means that at the end of its life, so let's say you've had the asset for 5 years, it will hold some kind of remaining value. Now, for corporations, these fixed assets are going to be pushed and run to the ground, right? They're meant to be massive, right? They're meant to be in production like almost 24 hours a day, okay? So think about it. If that's the case, these machineries or these type of fixed assets will not have a value at the end of the day because of the amount of usage that a typical corporation will have. So in this case, this is GAAP and IRS. They tell corporations that they must follow these two guidelines. However, because we are going to be a sole proprietor or a small partnership, anything like that, we actually get special privileges for the estimated useful life and salvage value. Okay? So, for example, estimated useful life, right? Since we're a small business, we wouldn't be using equipment as often as a corporation would. We're not going to run it down to the ground like a corporation would, just because we don't serve as many people as a corporation does, right? Corporations serve about millions and billions of people, while, a small business would maybe get like a couple thousand, okay? So that means what we can do here is that we, as a sole proprietor, get to determine the, the total estimated useful life, okay, of a fixed asset. For example, right? Let's say I buy a printer, right? I'm only printing maybe 1 or 2 spreadsheets a day. That printer can last me at least 7 or even 10 years, okay? As long as I just keep it maintenance by, updating its software, or by, changing out the ink so often. But in this case, right, I'm only pushing 1 or 2 pages a day. So in this case, right, that means a printer could last me much longer than what a corporation will determine, right? But of course, you can't just say, oh, I bought a printer, it's going to last me 20 years. No, you do need to have your research done and determine some kind of methodology for you to be able to come up with this number. Now, usually, if you don't know, all fixed assets have written on the box of the approximate useful life. So in this case, you don't actually have to do in-depth research, but if you could justify it, right? So again, printers, I believe they have a capacity of how many pages it can print up to, right? So again, they say a laptop, right, has a battery life of 3 to 5 years. Okay, if that's the case, and that's the lifespan of that laptop. However, so again, the manufacturers already do that for you. So you don't necessarily need to have to do your research at all. However, as well as for this, right, if you do not want to do your research, right, you can also use the rules that GAAP aligns out for you. So you also have access to use the Blue Kelly book if you'd like. So for example, right, if I bought a laptop, right, and I could say it lasts me 5 years because it falls under computers. All right, so that's the cool thing about being a sole proprietor, is you get to choose and determine your own estimated useful life, whether you use the one that's already pre-made, the one that's written on the box, or if you think realistically I'm only doing so much to a fixed asset, then it should last me X amount of years. Okay, so sole proprietors get to determine their own estimated useful life. Okay, we also get to determine our own salvage value. Okay, so mentioning the Blue Kelly book, right? Think about it. You buy a truck for $30,000, right? And for a sole proprietor, you're not going to drive it to the ground. You're not going to drive it as often because maybe your deliveries are local, or et cetera, or the distances that you drive, you don't drive it out too often as compared to a corporation, right? So in this case, especially for a vehicle, right? If you bought it for $30,000, there's no way that you're gonna say it won't have a salvage value at the end of its life. So let's say this car is supposed to last you 10 years, right? You can't say that it's zero at the end of 10 years because you're not driving it as often. So in this case, right, we could say realistically, I could probably sell this for scrap metal. at least for, $5,000. Okay, it should hold up to that value. Okay, if that's the case, then yes, as a sole proprietor, you get to determine a salvage value because you're not going to be using the asset as often as a corporation would, right? You will use it, but not as frequent. So therefore, it should have some kind of holding value at the end of its life. Now, you can also choose to not have a salvage value at all, just so then you can even out your books that way. Okay? So this is what I needed to explain, is that there is some rules and regulations for having determining an estimated useful life as well as salvage value. However, the sole proprietors get more leniency to choose and determine these values themselves. Okay. Then we're going to be talking about the date that you place the asset into service. Okay. So when we place our assets into service, right, we must treat our assets like our children, right? When a child is born October 1st, right? You don't depreciate it for one whole year once it's December, right? You depreciate it as soon as you put it into service. So if it was there October 1st, right, it won't become one until again October 1st of the next year. So in this case, right, that's why when we do date that you place into service, we must treat our assets like our children, right? Our assets, just because we place into service as of June or October, like I've mentioned, right? That doesn't mean it's already 1 year old once you reach the end of the year. Okay? No, it's only going to be 3 months old. Okay? Right? October, November, December. It's 3 months old. Right? So you're gonna treat your assets like you treat them like their age with like children. Okay? When you place them into service, it's going to determine when you start depreciating it. Okay? Now, not only that, it's also broken down into determining, are you going to depreciate that month or are you going to depreciate the next month? So if it falls between the 1st and the 15th, then you are going to depreciate for that month, because when you place into service, right, since if you placed it into service on the 5th of October, for example, right, that's more than 50% of the month. So in this case, right, that means you used it more, about, you like I said, 50% of the month. So therefore, you're going to be determining that you're going to depreciate it as if you had it for the whole month. Okay? If it falls between the 16th through the 30th or 31st, whatever the end of the month, then you're going to say, well, that's less than 50% of the month. There's no way that you're going to lose out a whole month's worth of depreciation when you barely used it. Especially, let's say I put into service on the 28th of October, right? Is it fair to me that I could say that I depreciated for a whole month? You only had it for 3 days. Okay, so in this case, that's the rule here. If you place into service after the 16th through the 30th, the 31st of the month, then you're going to choose to depreciate for the next month, right? Because in this case, again, you only used it for less than 50% of the month, so you're better off depreciating it the next month. Okay? So again, when depreciating assets, you must consider when the date that you placed it into service, because they're like children. Okay? They have ages, and the ages begin when you place into service. Okay? It doesn't always begin the day that you purchase it, because there might be things that you need to add to it for you to be able to put into service. Okay? When you place into service, then that's going to be determining when you start depreciating it, and that's when its age begins. Okay? And then last but not least, step number 5, you are going to be determining which depreciation method you're going to be using. Now, in this case, right, there are many different depreciation methods that exist today. This is just only a few that are listed here. Now, the ones that are bold are the most commonly used one. They're much more easier and much more feasible to use. But again, there are a lot of different depreciations that you can use to basically devalue your fixed asset, right? But the more common ones I'm going to show you, I'm only show you three. So only three methods, and we're going to learn two today, okay? Well, the first one is going to be activity-based method, which is also known as units of production, which is going to be based on a capacity or based on the number of units that can be produced, okay? And the second one is going to be straight line. Third one's going to be accelerated, which is also known as double declining, okay? I'll give you examples of each one, of course, as we go through the depreciation methods, okay? Today we're going to learn the very first one, or right now we're going to learn the very first one, which is activity-based method, or also known as units of production. They're interchangeable, so whether you know it as activity-based or units of production, they're interchangeable, okay? So let's talk about units of production. So units of production, right? We've mentioned, I barely mentioned this, that we depreciate based on a capacity, okay? What does that mean? Well, in this case, right, we're looking at how much a fixed asset can produce, right? So for example, let's say you bought a machinery, okay? And let's say it can produce X amount of units, okay? So that means if it's already predetermined that it can only produce up to X amount of units, then that's going to be your capacity, meaning any unit beyond the X amount, right, has potential and possibilities to be defective, right? Because again, your machine, it's being worn, it's wear and tear, right? Maybe the wheels don't roll anymore, or the gears, they're getting rusted, right? Or they need some oil, right? In this case, that's what I mean. Once you reach a capacity, you cannot go beyond it, because if you do go beyond it, once again, if you are producing products from this, there's a high risk of your products becoming defective, XYZ, broken, just because the machinery is not as its top notch as it was when you started using it. Okay? So here, these are the formulas that you're going to be looking and determining. You need to determine the depreciation basis. You need to determine the per unit rate, the depreciation expense itself, the accumulated depreciation, and the book value. Now, in this case, what you're going to focus most on is between the three different methods, the formulas that are going to be changing the most is going to be the first three: your depreciation basis, your rate, and your depreciation expense. Okay? Your accumulated depreciation and your book value, these formulas are going to be consistent and stay the same throughout all three methods. Okay? So let's go ahead and do an example to see how we could test this scenario out. Okay? So here's an example where you're going to record the depreciation for the first year, okay? So here you bought a machine, right? It cost you $15,000. Salvage value is $2,500, okay? Its useful life is 5 years. And the number of units that it can produce in grand total is 10,000 units, okay? And the date that you place into service is as of January 1st. Now, our assumption is that when we depreciate it, we're going to depreciate at the end of the year, December 31st. Okay, so in this case, if I place it into service as of January 1st, that means I'm going to depreciate it for a whole 12 months, which is one whole year. Okay? Now, it told me that the first year I produced 2,100 units. Okay? So this is going to be important information, right? Out of the 10,000, I produced 2,100 for the very first year of the asset's life. Okay? So let's go ahead and determine the first thing, which is the basis. Okay? So the basis is going to be the cost of the asset minus salvage value. So in this case, the cost of the asset was $15,000. The salvage value was $2,500. So in this case, it's going to be $12,500. That's my depreciation basis. Now, what does this depreciation basis determine? This depreciation basis determines how much you can depreciate up to. Okay? That means you can only depreciate up to $12,500. Okay? All right, so then the next one's going to be the per unit rate. Now, in this case, what does the per unit rate determine? In this case, it determines how much it's going to cost me per item that I produce. Okay, so in this case, I'm going to take my depreciation basis, which is the total amount that I can depreciate up to, right? And I'm going to divide that whole entire thing by the number of units that this machine can produce. So in this case, my capacity is 10,000 units. So that means I'm going to determine how much is it going to cost me per unit if I produce it, right? So I'm going to take my 12,500 and divide it by 10,000 to get $1.25 each. So that means every item, every product that I produce is going to cost me $1.25. Okay? So then now the next thing is going to be determining your depreciation expense. The depreciation expense is going to be the number of units produced that year, so 2,100, multiplied by my rate, which is going to be $1.25. So in this case, $1.25 times 2,100 is going to give you a total of $2,625. Okay? Accumulated depreciation is going to be the previous accumulated depreciation plus the current year's depreciation expense. Well, in this case, we're starting from the very beginning. We didn't depreciate any year before that. So that means I'm going to add my current depreciation expense for that year, which is the 2,625. So 0 plus 2625 is going to give you 2625. Okay. So then the last thing you're going to do is you're going to determine the book value. The book value is going to be the cost of the asset, so $15,000 minus the accumulated depreciation. So in this case, $15,000 minus $26.25 is going to give you a book value of $12,375. So, what does this book value determine? Well, it determines that after it's been a year, right? It's no longer going to hold the value of $15,000. It's going to be at least $13,000. So if you choose to potentially sell this asset, right, you cannot sell it for $15,000, right? Because right now you used it, it's worth now $13,000. Or in this case, yeah, $12,500 or whatever, close to $13,000. But in this case, right? When we figure this book value out, it's not always true that you're going to get $13,000 out of this, right? You could get $10,000 out of this. And we'll talk about that in chapter 11.5 on Thursday, right? What do you do when you sell your assets? Well, that's it, okay? But in this case, that's what I'm trying to tell you here is that this allows you to tell you what your book value should represent after you've already used your fixed asset. Okay, this is for the first year. Okay, so let's go ahead and do the second year. Okay, so the second year, we're going to plug our values in. So let's say for the second year, I produced 2,000 units. So I go through the cycle all over again, right? Depreciation basis, cost of the asset minus salvage value. So 15,000 minus 2,500 gives me 12,500. The per unit rate is going to be depreciation basis divided by the number of units that it can produce in grand total, which is still going to give me, which is your 12,500 divided by 10,000, which is still going to give you $1.25. The only difference here is my depreciation base, my depreciation expense is going to be the number of units that I produced that year, multiplied by my rate. So in this case, what you're going to notice is, if I go through everything every single year, I'm going to notice that my depreciation basis and my rate, once you solve for the first one, it's going to be consistent, right? For the next round, next year, right, depreciation basis is the asset cost minus salvage value, which is still going to be 15,000 minus 2,500, right? However, the only difference here that you see is that when you get to the depreciation expense itself, right, it's determined based on the number of units that you produced that year. So in this case, right, that one, I was able to produce 2,000. So 2,000 times $1.25 gave me 2,500. Okay? And then for my accumulated depreciation, I take my previous years of 2625 and I'm going to add 2,500 to that to get me a total of 5,125. And I take that 5,125 and I subtract that out from my asset cost to get my total book value. So now after year 2 of using it, right, my asset is now worth 9,875. Okay? So this is how I slowly depreciate and use my fixed asset. Okay? So, like I mentioned before, what you're going to notice is that if you actually tally up your totals for the 5 years that you've had the asset in service, right, it should equal the total amount that you have as your capacity, right? Your 10,000 units, okay? And again, your depreciation basis as well as your rate. Once you solve it for the first time, right, it's all going to be the same afterwards. So again, the formula is going to be the same. So therefore, your numbers are all going to appear to be the same. So in this case, once you solve for one, you pretty much solve for the rest already. Okay? And then what you're going to notice is your depreciation expense is actually going to be different because it's based on the number of units that you produced that year. So if you produce that year varies, right, then your expense will change as well. Okay? And then, of course, at the end of the 5th year, right, what you're going to notice is that you should end your accumulated depreciation to be equal to your depreciation basis, okay? Because that's how much you can depreciate up to. And the last but not least, your book value at the end of the 5th year should equal to your salvage value, okay? All right? So let's take another example, right? What if on my last year, I end up producing a little extra here? I end up producing 12,200 units, okay? Okay, let's go ahead and just go through the motions and see where we're at, okay? So in this case, right, my depreciation basis is going to still be 12,500. My rate is still going to be $1.25. But depreciation expense is going to be 2,750, right? Which is going to give me an accumulated depreciation of 12,750, which is going to drop my book value down to 2,250. In this case, right, we cannot accept this, all right? Because the huge rule here is that your book value can never fall below salvage value. So that means you're capped at whatever salvage value that you determined, right? You cannot extend, you cannot devalue, you cannot change this value, okay? And again, you can only change that, or we'll talk about that chapter 11.5. Okay, that's only if you add any fixtures to this. But in this case, no. Your book value should never fall below salvage value. So in this case, whatever your salvage value is determined should be what your ending should be. Okay? And on top of that, you cannot ever go beyond a capacity, right? So there's many rules and regulations when we understand what a capacity is, right? So think of it like a room, right? A room has a capacity of how many people should be in there, right? Because of rules and regulations, especially when, if there's a fire going on, you can't have that many people in that room, and so on and so forth. So again, a capacity is very important. In this case, if you actually calculate how much total units that you produce that year, it goes beyond the 10,000 units. Now, what do we say when you go beyond 10,000 units? That means any extra unit that you've created, right, has a high risk of being defective, damaged, okay? Just because, especially when you're using machinery to build your product, right, it's not going to be as good as it was in the very beginning because you pushed it beyond its capacity. You're basically going beyond what it can do, okay? And we all know, right, results after beyond pushing something to the limit, right, it doesn't really perform very well towards the very end of its life. And that's also true for this as well. You can't go beyond the capacity. So how do you fix it? Well, you determine this. What are the two things, right? You need to determine what the capacity is, which is in this case 2,000 is my max capacity, or you can determine what your salvage value is, which is book value must equal to salvage value, right? It can be over, but it cannot go under, okay? So in this case, it should be equal to the 2,500, and your capacity is 2,000 units. Okay? Any questions? No. Okay. So how do we journalize this transaction here when we calculate our depreciation? So in this case, right, the first thing that we said for our scenario was you need to journalize the very first years of depreciation. So once we figured out those numbers and we calculate it, right? So our first year when we created 2,100 units, right? We had our depreciation expense for that year to be 2,625. So that's what you're going to have to determine. You're going to be determining two things, okay? Depreciation expense, okay? Right? That's what you're doing, and it's an expense, so that's why it's debited. And like I've mentioned before, right? You're not going to directly take this amount off of your asset itself. You're going to create a contra account called the accumulated depreciation, right? And that's going to, because it's a contra account, it will decrease the value of the fixed asset for you without adjusting the actual price of the fixed asset, right? Because contra accounts, remember from chapter 2, contra accounts decrease or flow in the opposite direction as the main account that it's deflecting, right? So in this case, we learned that accounts receivable, right? If a person doesn't end up paying you, you must move it into a counter account, a contra account called the allowance for doubtful accounts. They are the same. The only difference is you're moving it into another account to represent this transaction and their contra account. So it decreases the main account. Okay? So there you go. Depreciation expense and the accumulated depreciation. Now, once again, these are considered adjustment entries. Okay? These things happen usually towards the end of the month, the end of the year. But I'm going to tell you this, depreciating it by the end of the month, you can do. It's not wrong. Yes, you can do it at the end of every single month, so you don't have to do it at the end of the year. Okay? Whichever makes it easier for you, because at the end of the day, when you depreciate for every single month, it's going to accumulate to the same amount that you would do for the year. Okay? So, but usually this is an adjustment that you typically would do at the end of the given accounting period. So that's why it's called an adjustment entry. Okay? All right? So let's go ahead and journalize for the second year. Second year, right? We have 2,000 units that we produce at $1.25, which yield to me 2,500 for my depreciation expense. So in this case, what I'm going to do here is depreciation expense is going to be for 2,500, and you're going to put it into your accumulated depreciation. Now, do not confuse the accumulated depreciation from the journal to your table. Your table is more or less the same as your ledger. This is what you tallied up in total that you've accumulated the depreciation for. That's how you determine the book value. In this case, your journal is saying that we're just tapping into this account right here. So when we look into ledgers, right, since you tapped into the ledger twice, you tapped it in for the first time for $26.25, then you tapped it in again for another $2,500, then your grand total in your accumulated depreciation is going to be the $5,125. Okay? But in this case, this is the journal, right? We're depreciating it, or we're recording our transaction at time of the transaction, right? We're not looking at ledgers. We're looking at what happened and what occurred. So in this case, we just did depreciation expense for the $2,500. Okay? Any questions so far? No. So then, let's talk about what happens when there is a date that you place in service. Okay? So we talked about how dates of placing things in service is very important, especially when you're dealing with fixed assets, right? Because we treat our fixed assets as if they have an age, right? They have an estimated useful life. So in this case, the estimated useful life here is 5 years, okay? But we place it into service as of the 18th of October. So when do you actually start depreciating it? So if you remember the rule of thumb, if it falls between the first 15 days, you depreciate starting that month. But if it falls after the first 15 days, or you put into service after the 15 days, then you're going to depreciate the following month. So in this case, right, here's the rule of thumb. Since you put it into service as of October 18, that tells me, okay, well, it's past the 50% mark, right? Past the 15. So in this case, I'm not going to depreciate for the month of October. I'm going to push it to the next month for November, okay? And then if I am determining depreciation at the end of the year, right, I'm going to depreciate for November 1st all the way to November 30th and December 1st all the way to December 31st. So therefore, I'm only going to be depreciating it for 2 whole months, okay? So let's go ahead and take a look at this example here. Between that 2 months, right, you were given that you produced 250 units. So in this case, you're going to go through the same process over again. You're going to determine the depreciation basis, the rate, the depreciation expense for that year. So this case, right, my first year, because I'm using calendar year, right? I'm starting from January to December, and I have to recalculate every year after that, right? My first year is my fixed asset's only 2 months old, so it only was able to produce me 250 units. So depreciation basis. So we're gonna take my $10,000. We're gonna subtract the 2,500, right? Asset cost minus salvage to get the 7,500. We're gonna get the rate as the 75,000 divided by my capacity of 25,000, which gives me a total of 30 cents per unit. Now, because I only produced 250 units, right? 250 times 30 is going to give me $75. Okay? Now, let's determine this. In this case, we already know my asset's only 2 months old. So therefore, it only produced a total of 250. But let's actually really do the math. If you have a capacity of 25,000, right? And it could last up to 5 years, right? You should be depreciating about roughly 5,000 units per year, right? 25,000 divided by the 5 years. So that means every year you should produce at least 5,000. In this case, it's already predetermined that your asset's not 1 year old. It's only 2 months old. So therefore, out of the 2 months, you only produce 250 units. So in this case, this one's already predetermined. Now, who is the one that's giving you these numbers? It's going to be the person who's in charge of the machine. So the inventory manager, the one that's producing the products, they're going to tell you this. So this is predetermined. All you have to do here is now, moving on forth, is solve for the depreciation expense, okay? So once you've done that, then this is how you journalize it. You journalize it for the 250 units for $75 and so on and so forth, right? So in this case, this is where time is not sensitive because you're given how many units it produces that year. So in this case, this one, the date that you place into service is not going to really matter, but it will matter for the next two depreciations, so double declining and straight line, because again, right, you're not going to determine for the whole year, you're only going to determine a portion of the year. In this case, it's already pre-calculated for you, okay? So chapter review, we talked about depreciation. We talked about there's 5 components of depreciation, right? We talked about what determines the depreciation method, okay? And like for example, the components. So what determines the estimated useful life as well as salvage value? What depreciation methods are there, as well as in this case, we determine when the date that you place into service. Okay, and here's an example of how you journalize the depreciation. Okay, because we're only looking at the first one, here's the very first one, which is units of production, which is based on a capacity. Right? It's not based on anything else. It's not based on age or anything. It's based on its capacity of how many units it can produce. Okay, so that's huge there. And here are the formulas for you to help you out when you are calculating. Okay. So any questions for 11.1? All right, so let's go ahead and do the exercise together. Okay. So here's the exercise. We're going to fill out this table. Okay. So question number 1, okay, you purchase a printer for $150, okay, with no salvage value, all right? And its useful life is 5 years, and it can produce up to 10,000 pages, okay? And of course, you put this printer into service as of January 12th. So in this case, what is my asset? What did I buy? No, we bought a printer. Good. How much did this asset cost me? $150. Okay. What's my salvage value?
No salvage value.
No salvage value, so 0. Okay. What's my useful life?
5 years.
5 years. What's the number of units that it can produce?
10,000.
Yeah, that's my capacity. It can only produce up to 10,000 pages. And last but not least, when's the date that we placed into service?
January 12th.
Okay, so what does that tell me if I placed into service as of January 12th? When am I going to depreciate it?
January.
We're going to depreciate it starting January. Okay? So down below, here are the predetermined number of units that you produce that year. So in this case, right, we produced for the very first year 2,100 pages. Okay, so what's my depreciation basis going to be?
I forgot all.
It's okay. Yeah. Okay, so the depreciation basis is going to be?
Cost of asset minus salvage value. So it would be just the cost of the asset. Since there's no salvage.
Correct.
So,
right, so it's just going to be 150, okay, minus salvage value, which we know is 0. So therefore, correct, it's 150. Okay? So then how do I determine my rate?
depreciation basis estimated units. So it's divide.
Mm-hmm.
Depreciation. So 150 divided by 10,000.
Mm-hmm. By the number of units that it could produce. Okay? And what do I get?
Point 15.
Mm-hmm. 0.15. Okay? So then if I produced 2,100 pages and it's going to cost me 1.5 cents per page, what is going to be my total depreciation expense?
So it's gonna be 0.015 times 2,100
Mm-hmm.
equals 31.5.
Okay, good. $31.50. Okay? So how do I determine my accumulated depreciation?
Previous year's accumulated depreciation plus current year's depreciation expense.
So in this case, do I have a previous year?
No.
No. So that's 0 plus. What's my current year's depreciation?
3150.
3150. So it gives you 3150. So in this case, you can always memorize that the first one is just going to equal the depreciation expense for that one. Okay? How do I determine how much my printer is going to be at the end of the first year? How much value does my printer have now?
Cost of asset minus accumulated depreciation. So it'll be the 150 minus 3150
Correct.
minus 31. 11850.
11850. Good. Okay. So let's determine the next one. Okay. Second year, right? What's my depreciation basis going to be?
11850.
No, not book value. So what's my formula again?
Cost of asset. Oh, okay. So it's 150.
Good, right? It's 150 because it's cost of the asset, right? Minus salvage value. So 150 minus salvage value. So what you're going to notice is that this is going to be constant. Okay? What about your rate? It's also going to be constant because the depreciation basis never changed and your total capacity never changed. So in this case, you're still taking the 150, dividing it by the 10,000, and you're still going to get 1.5 cents. Okay? So now that for my second year, I produced 2,200 units. So in this case, what's my depreciation expense going to be for year 2? $33. Okay? So then what's my accumulated depreciation going to be?
33.
It's the previous year's plus
6450.
64, right? You're going to take your 3150, you're going to add 3350 or 33, and that's going to get you 6450. Good. So then what is the value of my asset now after using it for 2 years?
$85.50.
8550. Okay. Let's continue. What about year 3? If I produced 1900 units at a penny and a half, how much is my depreciation expense going to be for year 3?
$28.50.
2850, which is going to give me a total accumulated depreciation of, so previous
93.
years, I'm sorry?
93.
93, right? It's the previous years of 6450 plus 2850 gives you 93. So what is my book value then?
57.
57. Good. All right. Last 2 years. Okay. Year 4, I produced 2,000 units. What's my depreciation expense?
30.
30. Okay. Accumulated depreciation?
123.
Yeah. Right. 93 plus 30 equals 123, which will give me a book value of
27.
$27. Last but not least, on year 5, I produced 1,800 pages. So, what is going to be my depreciation expense?
27.
$27. Okay. So, what's my accumulated depreciation?
150.
150, which will give me my book value to equal
0.
0, which is equal to my salvage value. Good. All right. So questions 2 and questions 3 says, let's go ahead and record the adjustment entry for the first year, and then question 3 is for the second year. Okay. So how do I record my depreciation for the first year?
It'll be depreciation expense.
Mm-hmm.
And then accumulated depreciation.
Good. I'm going to do ACUM for short. Okay. And it's going to be for how much for the first year?
150.
Not 150. That's how much it cost me.
118.50.
$118.50. No, that's how much it's going to be after. What's my depreciation expense for the first year? What did I calculate here?
41.50.
$31.50. Okay, $31.50. Okay. What about the depreciation expense entry for the second year? Right? It's going to be identical. The only difference is the number's different. What's my depreciation expense for the second year?
33.
$33. Good. Okay. Excellent. All right. So let's move on to the next question here. Questions 4 through 6. So you're going to do another example of a depreciation here. Okay. So, but this time, okay, number 4, you purchased a truck for $36.80, okay, which includes all fees, okay, with a salvage value of $5,000, okay. Its useful life is 7 years, and its mileage is up to 150,000 miles, okay, and you put this truck into service on August 25th. Okay, so assume that the adjustment entry is going to be at the end of the year. Okay, so in this case, what did I buy?
A truck.
You bought a truck. Okay, how much was the truck?
Is it 36,000?
$36.80. Okay. What's my salvage value?
5,000.
5,000. Okay. What's my useful life?
150,000 miles.
Useful life.
Oh, 7 years.
7 years. And then the number of units it can produce is 150,000 miles. Okay. And last but not least, what's the date that we placed into service?
September 1st.
Okay. You're looking at, so here this, I put it in October, on August 25th. Therefore, you determine that September 1st. Good. Okay. Okay. So, all right. So let's take a look. So the first year you drove 10,000 miles. Okay. So let's go ahead and determine what is the depreciation basis for this. What's my depreciation basis?
5,000.
That's salvage value. What do you need to do with that salvage value?
Subtract it
From
the cost, the asset.
good. So 36,080 minus salvage value of 5,000 is going to give me
3180.
3180. Good. What's my per unit rate?
So it would be the 3180 divided by the miles.
150,000.
Yeah.
Which gives me
0.21.
okay. In this case, we're not going to round up. Okay, I'm going to expand as much as I can, but it's 0.2072. Okay, so in this case, right, if I drove 10,000 miles for the very first year, how much is my depreciation expense?
$2,072.
2,072. Good. Okay, so what is that going to be for my accumulated depreciation? What's my previous year?
Nothing.
Nothing. And then what's my current year's depreciation expense?
2,072.
So in this case, it'll be 0 plus 2,072 gives you 2,072. Okay. What's my book value going to be at the end of year 1?
2,072.
No. What do we do with that accumulated depreciation?
Cost of asset minus accumulated depreciation. 36 minus 2,072. So it'll be 3408.
Good. All right. So that's the first year. So let's determine the rest. Okay. What about my depreciation basis for the second year? Basis.
Cost of asset minus salvage value. So it would be the 3180.
That's the depreciation basis, not the cost of the asset.
36 minus 5,000. So it'll be 3180. Oh, so that's gonna be the same one.
Good. This is going to be the same all the way down. What about my per unit rate? What about my per unit rate?
It's the 3180 times 25,000.
Not times.
Divide.
Yes. So not 25,000.
150,000.
150. So it's based on the total number of units it could produce entirely.
Okay. 3180 divide 0.2072.
Right.
So that's going to be the same always too.
Yes. It's going to be the same all the way as well. Okay. So that means the only difference that I'm going to be doing here is I'm just going to be solving for my depreciation expense. And that's going to be different every year. So in this case, if I produce a total of 25,000 miles, okay, for the second year, then how much depreciation expense is it going to be for the second year?
5,180.
Good. All right. Which will give me an accumulated depreciation of
5,180.
plus.
Oh wait, yeah, plus the 2,072.
Mm-hmm.
7,252.
Good. All right. Will give me a book value of
So it'll be the 36 minus 7,000.
mm-hmm.
What was the amount again? 36?
3680.
3680 minus 7,252. 3680
3680.
minus 7,000.
252.
28,828.
Yes. Good. All right. What about the depreciation expense for year 3? If I drove 20,000 miles. I'm sorry. If I drove 19,000 miles for year 3.
3,936.80.
Okay. What's my accumulated depreciation?
$11,188.80.
Okay. Which will give me my book value to be
What was it? 60, 3680. 3680 minus 34,961.20.
34.
34,961.20.
Okay, so 36.
Oh yeah. I don't know what I did there. Okay. 3680 minus 11,188.20. 24,891.
Good. All right. Let's keep going. All right, year 4. What's my depreciation expense if I drove 20,000 miles?
4,144.
Okay. All right, so then what's my accumulated depreciation?
15,332.
Okay, which is going to give me a book value of
20,747.20.
good. Okay. What about year 5 if I drove 18,000 miles?
3,729.60.
Okay. Giving me an accumulated depreciation of
19,062.40.
good. And then last but not least, how much should your book value be at the end of year 5?
17,017 with 60.
Okay, good. So I'm going to go ahead and fast forward since, you get the concept. Okay, so again, depreciation expense is going to be the number of units that you produced that year times the rate. So in this case, if I drove 22,000 miles, it would give me 4,558. And if I drove 26,000 miles the very last year, it's going to be 5,387.20. Okay, my accumulated depreciations, right? You just add your previous to your current, right? So your previous of 19 plus the 4,000 gives you 23. And then your book value is just going to be the cost of the asset minus the accumulated depreciation, which will result like this. So now you're at $7,072 for your 7th year of depreciation. Now, can my assets keep going? Can I keep on driving it?
No.
Why? Why can I not keep on driving it?
Because, wait, you can't.
Yes, I can.
Because it's not under the 5,000.
Perfect, right? You still can keep on depreciating because it's not even 5,000 yet for my salvage value, right? But what else? How old is my asset?
It is 7 years.
That's how many years we depreciated it. But how old is it really? If I placed into service as of August 25th,
I'm not sure.
so if I placed into service as of August 25th, and every year I'm depreciating it, it's going to be December. So the first year, how old's my asset?
3 months.
It's only 3 months. Plus another 6 years.
6 years, 3 months.
It's only 6 years and 3 months old. So in this case, it still has a life. It can continue to keep on going. But what else? Have I met my capacity yet? My capacity is 150,000 miles. How many miles have I driven so far? So far, I've driven only 140,000 miles. So how many more miles can I actually keep going?
100,000? No. 10.
10,000. So in this case, I can only drive 10,000 more miles, right? Because I haven't reached my capacity yet. Second thing is, it's only 6 and 3 months old, right? 6 years and 3 months old. So in this case, it still has a life. It could still keep on going, okay? So in this case, right, my depreciation basis, okay, is going to be the same, right? It's still going to be the asset cost of 36,080 minus 5,000 gives you 3180. And my rate, because my basis is the same, my rate's going to also be the same. So in this case, what is my grand total for my depreciation expense if I drove 10,000 miles? If I drove 10,000 miles at 20.72 cents.
One second. I'm using my phone and I don't know where I placed it.
No worries.
$2,072.
2072, which is going to bring my accumulated depreciation. So 2072 plus my 2908. How much is my total accumulated depreciation?
3180.
Okay, giving me a grand total book value to be
I don't know how I forgot that stuff again.
okay. So it's your asset cost of 3680 minus your accumulated depreciation.
Minus 3180. 5,000.
Okay, good. So at the end of its life, right? Not this is how many years you depreciated, right? At the end of its life, it hasn't reached 7 years yet. Okay? You have a salvage value of 5,000. Good. Your accumulated depreciation matches your depreciation basis at the end of the 8th year. right? So in this case, everything worked out good. So next part says right here, you're going to enter in the adjustment entry for the first year and the second year. So how do you journalize this transaction?
Depreciation expense and accumulated depreciation.
Good. All right. So for the first year, how much depreciation expense?
$2,072.
Good. And what was my depreciation expense for the second year?
$5,180.
Good. All right. Any questions here?